Okay, well, ladies and gentlemen, first of all, thank you for attending today's workshop. The presentation is Investor Behavior. It's easy to be your own worst enemy. My name is Brian Stormont. I'm one of the managing partners here at Insight Wealth Strategies in our San Ramon office in California. Also joining us today is Chad Seegers. He's also a managing partner with Insight out of our Houston, Texas office. The purpose of today's discussion is to cover a couple different topics. The first of which Chad's going to talk about is the construction of your portfolio. So really, the way in which one builds their portfolio and the decisions they make about how they allocate their capital is going to be critical to the overall performance and risk profile of their investment portfolio. And so Chad's going to talk a little bit about sort of the thought process that should be going into that process itself. Then I'm going to talk a little bit about some of the psychological, mistakes that we as humans just can make when we talk about, how we approach our investment portfolio and the decisions we make around our investment portfolio. And then we'll close with a little bit of just a comment or two about what it means to be working with Insight Wealth Strategies. So without any further ado, Chad, I'll let you take it over from there.
Thanks, guys. So portfolio construction. Most people are saving and investing today, and they're using some form of portfolio construction, whether they know it or not. There's a long-standing asset allocation theory that works over time, but a lot of people don't use the tools. And you can arrive at what your allocation should be with sort of a basic risk assessment. And a lot of people set things up, and they'll let them go for 20 plus years, and they don't necessarily change their level of risk. And meet a lot of individuals that are in their 50s, 1 or 2 years out from retirement, and they're 80 or 90% in the stock market. And that probably shouldn't be the case. So your risk assessment actually tends to change over time, especially after you go through a major market downturn. A lot of individuals tend to get a little bit more conservative. The next thing that you have, it's a great tool, is your horizon, and not necessarily you've got 30 years to work and save money, but even if you're near retirement age or actually retired, you still have a pretty large time horizon. And so what we refer to is something called time arbitrage. That's the best thing you have. And you go through market cycles like now, where you're inundated with things from the media, and people tend to focus on what the Dow is doing, specifically quoted in points, and it really magnifies some changes, and they start to focus on what's going on in the markets in days and weeks time versus months and years. And that should still be in play even when you're retired and taking money out of your portfolio. The actual asset allocation framework, there are many methods to get to what you should be invested in. And a lot of them work, frankly, with very high probability. And then there's the ongoing monitoring, rebalancing, which a lot of people unfortunately don't do. They fall prey to a couple of these emotional errors that we all fall prey to at times. So let's talk about a little bit on the construction side. There's a lot of published and defended methods of creating a portfolio that works. And we won't get into each of these, but just sort of group these as evidence-based investing. What if you just stuck to what the evidence says works throughout time? A lot of times investors come to us and they ask me, what's the best strategy? And there's a lot of strategies that work and they perform out there. And my response typically is the one that you're going to stick to. There are strategies that will underperform for a period of time, depending on the market cycle. And a lot of people will abandon them at exactly the wrong time. The strategy isn't broken. You just go through a period where it doesn't work for whatever reason. And so you have to sort of understand, who do you want to be as an investor? A lot of people want to be in what's hot lately. Do you want to be in Tesla stocks or the famed FANG stocks? That works for a period of time. That's actually a momentum-based strategy, and they don't realize it's a momentum-based strategy. And therefore, when that momentum breaks, you shouldn't actually be in those holdings anymore. But what the data actually says is, if you take these known investment strategies and you equal weight those strategies, so you've got a couple of different strategies that are doing some different things, you're going to beat, hands down, what the basic form of active management was. And that's tough for people to accept. It's tough for professionals in the industry to accept. But what this is saying is, do the things that work and stick to the things that work, and don't try to put yourself in a position where you're getting into estimation or optimization error. What do we mean by that? This is, dark blue line. This is simply equal weighting known decision factors in the market over the past 17, 20 years or so, versus the sort of old school method of volatility weighting. They're playing a mean reversion here. They want to buy some of the stuff that did poorly or buy more of the stuff that actually did well recently. And what you see is hands down, simply equal weighting known strategies works, and it works over a very long time series. Is going through a couple of recessions, several market blowups. We see a lot of people that come in that simply own quote unquote 5-star mutual funds. These things aren't always what they seem. There was a great paper written some years ago that covered the harm in selecting these sort of high flying options. What they found was fascinating. They looked at the recent 5-star fund winners, and they looked at the actual losing strategies, the quote unquote 1 and 2-star mutual funds. And what they found in the data was the next 36 months after a fund got their 5-star rating, that winning strategy was the lowest return that you saw for any grouping. You actually did better in your portfolio if you bought the 1 and 2-star funds over the next 36 months, and you simply continue to replicate this. That's totally contradicts the marketing element of the financial industry, really and truly. And you can sort of do yourself a lot of harm by following these newsletters type things. So why do you construct a portfolio to begin with? Because we all go through this emotional cycle. And so high level strategies help to smooth the emotional cycle. They help to smooth the experience in the market. They help to give you a time to actually rebalance when some things have done better than you thought. And that's this sort of first level. You buy something, you think you're the smartest person in the world, and it goes straight up. And this was cryptocurrency probably a year and a half, 2 years ago. And that was going to change the world. That's the point of actual maximum financial risk, because you typically, if you take a step back, you can't back into the numbers to make that type of investment work. Then things start to sell off. You tell yourself you're in this for the long term. Then people start to panic. They give up and they just sell and ask questions later. That's typically the point of maximum financial opportunity. This is financial crisis type setup. Now you've got some small companies that are roughly 12% of small US companies right now are trading for less than liquidation value, which is a pretty significant dislocation you haven't seen since the financial crisis, and you only saw one time before that in the last 40 years. And so you get these setups that are driven around market emotion. People forget that the market is a complex adaptive system with information cascades. And so a lot of times your investor edge is not because you saw something in a news article. It's typically related around numbers and related around earnings and the masses indication of where they think that price is. And we get inundated today with all of these types of articles. This one came out in Bloomberg 2019, posing the question, is inflation dead? And people were saying inflation would never rear its head again. The Fed has control on inflation forever. Lo and behold, what we've just experienced the past year and a half, 2 years, is getting back to 70s style, late 40s style inflation, hopefully peaking around 9.1% in June, and then continuing to fall through the rest of this year. But had you posed your investment thesis around low inflation forever and got into long-term bonds, specifically that had the highest yield back then, you'd be hurt pretty poorly right now. However, now that we're in this high inflation regime, a lot of people feel like it's going to be here for a while. What does that mean about the markets? When you look at data, the past 100 years, these green mountains across the top with the arrows pointing to the peak, this is actually the trailing year-over-year inflation measurement. And the arrows are the peak of that measurement when it begins to fall. And then the line across the longer term, this is actually the stock market. And the arrows are pointing to the actual peak of inflation. And what you notice is even though inflation remained high, the peak of inflation actually was the bottom of major stock market sell-offs. And that included the 70s sell-offs and the late 40s sell-off that we saw. And when you take a look at this data and you compile this, what you find is that the market typically bottomed plus or minus 1 month after inflation peaked. And that happened, whether you had a recession or whether you didn't have a recession, did not matter. And so you could make the argument that if June was the peak of inflation, and June 16th, when the market was down 23 and change, and the NASDAQ was down 32%, that statistically that could have been the or near the bottom for this particular decline. But you have to use this data and pay attention to this data to make some rebalance decisions. We hear things like there's going to be global food shortages, and the unfortunate situation going on in Ukraine caused a spike in both corn and wheat and many other commodities. What you don't hear now is that those commodities are back below pre-Ukraine invasion prices. And so this affects everything we pay for at the store. It affects consumer behavior when they're aware of this data, but when you're not told that these commodities have now sold off the past couple of months, people sort of lose sight of that, and they fear that inflation is going to continue to run rampant. When the reality is basic materials have now fallen. You've got many basic metals that are down over 50%, cotton down 35% and change. And basic materials tend to lead inflation by about 6 months. And so when we look at that the next 4 months or so, we should see inflation begin to trend down, especially if oil stays where it is. So we get these events that happen, these market cycles that occur. And these market cycles, would show you that bad things happen continuously. It should also show you that, yes, we go through these brief periods of time when they feel like it's going to forever be a drawdown in the market. But the reality is the equity markets have still given you high single digits, if not 10+% returns for, over 50 years. There's no reason why it shouldn't continue to do so, plus or minus, obviously. The recession concern a lot of people have that, it'd be tough to say that we're in one today, but the trends all indicate we should be in one soon. The average recession only lasts about 10 months. We have a recency bias because of the financial crisis that was a year and a half, and that was actually a debt recession. We've only experienced one other debt recession in history, and that was during the Great Depression. But the typical recession is only around 10 months. And the thing that most people can mess up with this is the stock market and the economy rhyme, but they're not the same thing. And the stock market tends to bottom months, at minimum, a couple of months before the economy or GDP actually bottoms. And by the time that GDP finishes falling, the stock market is typically up double digits. By the time the economy turns around again, and we get this comment a lot, I'll just wait for the economy to pick back up and then I'll get back into the market. The stock market's usually off to the races, high double-digit returns by that time. And so what a lot of people confuse is that the economy or recession is going to indicate what the stock market is going to do. It's actually the reverse. The best leading indicator for the economy is the stock market. That tells you more forward-looking indication of where the economy is headed. What's pretty fascinating is if you look at every single recession post-World War II, and you look at the 6 months before that recession began, the stock market's not always negative. In fact, it's about a coin flip, 50-50, whether or not you're in negative territory. During the actual recession, the stock market is not always negative. It's a coin flip, whether or not the stock market is in negative territory. How can this be? Well, the stock market is really 4,000 or so publicly traded companies. Of that, 80+% of the stock market is in the top 500 or so. And so you're talking about what 500 publicly traded companies are doing versus what the electrician, the plumber, the car wash down the street, what those types of businesses are doing. And so there is a bit of dislocation in returns. But what you see is, 1 year out, every single time series, the market was back up to all-time highs, with the exception of 2001. I think, an indicator, November 2001, 2 months before that, unfortunately, 9/11 occurred, and we had another sell-off that, caused this time series to not always hold true. But a great comment was said by a client recently when we're talking about recession expectations. They kind of shrugged and said, yeah, I think I remember some times when we had to go home early, there wasn't enough work. But doesn't the market always get back up to all-time highs? And that's an absolutely true statement. I've had a view, I came into this industry before the financial crisis and went through the financial crisis with many clients that had just retired, that you have the ability actually to make some pretty good money during the recession. And that's if you were a little bit more conservative the majority of the time, and you stick to your fundamentals, you stick to your rules around how you should construct a portfolio. You've got the ability to rebalance, which is a term that's thrown around a lot, but not fully understood, and buy some things that are cheap because you weren't over levered going into that recession. And so how do we actually construct a portfolio? It's based on data. We use evidence-based multi-factor construction. What's a factor? A factor is a basic decision metric for how you're going to choose which companies you want to invest in. And there are 6 main decision factors that have worked throughout every market cycle. Value is one most people know of. You buy a company that's cheap relative to the money they're making. Momentum, companies that have an upward price trend recently should continue to have an upward price trend. Low volatility, you want a company with stable, low risk, low debt. Size, smaller companies tend to outperform larger companies, makes sense, more volatile though. Dividend payers, you want companies that have consistent above average dividend yields. Not the highest dividend yields, but consistent. And the last is quality businesses. And quality business is defined as a consistent level and direction of earnings and a consistent level and direction of debt. And so if you combine these in portfolio construction land, you end up with evidence that shows you actually can outperform the underlying market. And this is 15 years of data showing that these factors, just these factors alone, they're not getting in and getting out of one or the other, for the most part, have outperformed the market. Some have done so with less risk. Some have done so with slightly more risk over a pretty significant time series. And you see this repeatedly now that we have these wonderful machines that we can look at old security prices with. It works. And so if you take a look at every single year, this is showing you what the best asset class was on the very top, what the winner was year by year. At the bottom is the lowest performer. And you look at this time series from 2005 to 2019, just before COVID, what you see is the best annual return came from large US companies, 9% return. It's tough to guess what is going to win year in, year out. Some people engage in this. They use what's called capital market assumptions. They're going to try to determine, well, I think we need 15% in real estate. I think we need 5% in emerging markets this year. And the next year they'll say, well, we need to put 10% in emerging markets. That's actually engaging in what's referred to as optimization error. It's what they think, feel, and believe based on some metric, what's going to happen over the next 12 months with an individual asset class. We don't personally believe you can actually do that. That's actually driven by factor decisions. And so that large cap was the best performer. Now let's take a look at strategies. The same is true for known empirical strategies. Year in, year out, you're going to have a strategy that does the best. And what you find when you look at that same next to last annualized return column is that multi-factor portfolio where you literally had a naive approach and said, I can't guess which strategy is going to be the best. I'm going to invest in the known strategies that work. You outperformed the single best asset class during that time series by almost 1% per year. It's pretty significant. So you don't have to be a Warren Buffett to actually have great outcomes in portfolio construction land. You simply have to stick to what is known that works. What do we do to stress test your portfolio? We want to make sure, number one, I don't necessarily care about the market cycle, but is it aligned with your personal goals? We meet people that have a pretty significant concentrated stock position. They tell us they're going to retire in 2 years or a year, and they have 80% in company stock. That's a risky endeavor. We meet individuals that are going to retire in 6 months, and they have 80% in the stock market. We want to take a look. Do they have a pension that's going to account for some quote unquote bond or fixed income exposure there? So that more or less determines, backs into what asset allocation should be in our view. And then what's the tax efficiency of taxable accounts? You can have the best investment strategy in the world, but if it's not tax efficient, roughly a third of your gains will be eroded due to tax efficiency alone. So that's something you want to pay attention to. So we look at a measurement that's called turnover within taxable accounts. And then you want to look at market history with data for context. It doesn't do you any good if you're going through an event like we're going through right now and you don't have any context for what inflation is doing, where it's going, to help you make decisions. You're simply going to not participate, and sometimes that's not the best decision. Or you could be running full speed ahead into a brick wall if you're in tech companies heavily towards the end of last year, when all data pointed to you're at the highest valuation you've seen since the tech bubble, and you shouldn't be overweight that sector. And so then you want to understand what your own personal risk factor is given historical events. This is when you want to look at not necessarily what a percentage drawdown was for any given market, but what a dollar drawdown was for your personal portfolio. How would that make you feel if you go year one into retirement, your portfolio is down $300,000? And so you want to understand those implications, and that should help determine what type of allocation you end up going into to start. And then we want to take a look at, how do you stay on track?
So yeah, so here, first and foremost, I'll just kind of talk real briefly about, with Chad's presentation just now and the things that he talked about. Hopefully you can see that the approach that we take in terms of asset allocation and portfolio construction, there are innumerable methodologies that one can apply that range all the way from the very simplistic, just throwing a dart at a board, all the way out to the much more nuanced academic-based process that a person can take. And so having an idea of what that process is and staying consistent to that process is obviously really important, but also hard to do. And so that's where, perhaps having a professional assist you in that process may be appropriate. What I'm going to talk a little bit about are some of the psychological traps that we can fall prey to over time that cause us to deviate from our process or move away from the system that we've been using that, again, we know historically and from an academic standpoint leads to better total return over time. But again, it's these psychological errors that we can make that can cause us to go astray, if you will. And so the first concept here is the anchoring bias. So this is a real common one. It's the idea that your original idea, your original concept was correct. And so let's say you have a particular stock or a particular industry that you think is really up and coming. I give you a really good example of this, cannabis. Frankly, we had some clients, a couple of years ago who were really gung-ho on Canadian cannabis stocks. They thought that was the way to go. And as new data came in, as new regulatory changes were introduced here in the United States, they didn't really want to change their view on that. And so it's the idea on anchoring bias is that original idea was right. And as new information comes in, you basically look to try to form that data to fit your original view. So some of this is just human nature. And so some of this is trying to fight some of those just basic human nature concepts. But really the idea to negate this is trying to be open to the impact of that new data and seeking out other opinions that could check on this. Now, the second one is the sunk cost bias. This is a real common one too. This is the idea that I've invested in a particular, let's say, stock, and it's dropped in value. And I can't sell that now. I'd take a loss. I've got to wait till it gets back up. And then I can sell, and then I can move on to something else. Unfortunately, that can lead to protracted long-term declines. And there might be other better opportunities that are out there in the marketplace that you could take that reduced value and reinvest in and see growth out of. Good example of this one is going to be like, say, Kodak or Radio Shack as an example, where these were at one point good companies, but they continued to decline in value, and yet investors hung on to those stocks, and they eventually went bankrupt, and those investors were completely wiped out. Where at the same time there were many other technologies or retail operations that were much better alternatives they could have sold and moved over to and seen their portfolio recover on. Now, the next one is confirmation bias. So this is also a really common trait that we see today, where really we're looking to, the trap is that we're looking to seek out opinions that confirm my ideas and ignore or discount opinions that challenge that thesis. Now, quite candidly, this happens not just in the investment universe, but frankly, with social media and the advent of that, it happens out in the regular world too. And so sometimes we have to break through those echo chambers and look to try to hear other viewpoints that challenge our thesis and determine, hey, is there any validity to that? Does this make me want to go back and revisit my original idea and see if maybe it holds up given this new piece of information? So confirmation bias, very easy to fall prey to. The next one's the blindness bias. We jokingly, kind of somewhat jokingly, tongue in cheek, refer to this as the head in the sand approach. And it's the idea that people just want to not address whatever the elephant in the room may be, and deal with whatever problems may be there. And certainly with our firm, one of the ways we try to avoid this type of activity is by holding regular reviews with clients, checking in with them periodically. That way we try to hold everybody accountable to say, hey, if there's a particular issue that needs to be addressed, let's talk about it. Let's not just ignore it and hope that it gets better. That's how you proactively begin to address some of these ideas. Now, relativity bias, this is a really common one too, and this can come in a couple of different formats. So the basic idea here is, how am I doing compared to others? Now, first off, I'll say that using a benchmark to understand how you're performing relative to some other item is not a bad thing. So say, looking at how your portfolio is doing relative to, say, the S&P 500 index, that's probably a good rational system to maybe have in place. But it's also important to understand that there can be significant differences between those two portfolios, and why those two portfolios are different can account for a large difference in maybe why they're performing differently. So when you have one investor that's very conservative versus one that's very aggressive, we see this, sometimes people go to cocktail parties and they hear someone boasting about their great investment returns. Well, what you may not realize when that person's making those boasts is that they took on a considerably larger amount of risk than you might be comfortable with in their approach towards that investment. Another common example of this is where people come to us and say, hey, I've saved a lot of money for retirement. I think I'm ready to go. How do I look relative to other people? And again, comparing two different people and their savings is oftentimes a fallacy here. I have clients who have millions and millions of dollars saved up, and we've run the numbers and we go, yeah, you can't afford to retire. You got to go for a bit longer. Whereas I've got other clients where maybe they just got, a few $100,000, even maybe $1 million saved up. And we look at the numbers, we go, you could go tomorrow. And the reality is that no two people are alike necessarily in the way that they've approached their retirement and the amount of resources they've saved for it. So relativity bias is a very easy one to fall prey to. The last one is the irrational exuberance bias. So this one, if you were to hear the statement, well, this time it's different used, that's a really good sign that there may be irrational exuberance in the room. So we want to be very cognizant of the notion that we may be trying to ignore some of the historical precedent. Warren Buffett's got a great line that says, be greedy when others are fearful, and fearful when others are greedy. Now, irrational exuberance, the reality there is that can happen to the most basic of just sort of common everyday investors, all the way up to the top echelons of Wall Street. It's important to remember that back in the pre-financial crisis years, some of the smartest people on Wall Street were operating on the assumption that U.S. real estate did not decline on a national basis year over year. It always rose. And we learned, unfortunately, the hard way that proved to be not true. So again, you got to be careful about irrational exuberance. Now, there are other psychological traps that people can fall prey to, but those are just 6 really common ones. And again, it's not just pertaining to investments. These are probably attributes that we could find ourselves falling prey to in our own personal lives in a variety of other ways. But understanding that they're present and understanding that they can derail us from our process, just by knowing that they're there, can help us to avoid it or sidestep it, or at least acknowledge that it's present and in the room. So hopefully those are a couple of topics or a couple of ideas that you can maybe use for yourself and identify for your own personal use as areas you want to maybe be cognizant of and perhaps avoid.
Thanks, Brian. So just taking a look at the investment process, I think that, take this, use it for yourself. Even any type of investment process that you go through should start out with planning first. You can't simply just select a strategy based on performance alone. You need to understand, in our view, what the risk-adjusted returns are there. And only after you understand what type of portfolio construction is right for you, both now, near retirement, and then actually in retirement, that sort of determines portfolio modeling, analysis, and design, what you have in place and where you should be. And then you actually should develop what's called an investment policy statement. That's something you should stick to. And this can change over time. It's great guardrails that helps you say, okay, I want to take 60% risk in the stock market, and that's going to be about my max level plus or minus 10%. And after that's done, then you ultimately go through manager search and selection, which is kind of where a lot of people start They look at returns for some investment portfolio, and they start there, and that's it. And the last area, which is ongoing review and due diligence reporting, there's not much there. But this is an ongoing process as it pertains to financial planning, but into the investment piece as well. And so people tend to work with us because we have a dedicated team. We have a portfolio management team. I serve as investment strategist for the firm as well. We have people that handle cashiering, tax withholding. There's going to be a consistent review meeting schedule, typically quarterly, with whoever your advisor is on the team, going over what the market's doing, go over changes in your life, changes that may have occurred health-wise, et cetera, any projects we need to consider. So it's more relationship focused. And I think the thing to know is we're actually fiduciary. So we don't have any packaged proprietary strategies that we sell and get compensated more for, or any commission-based strategies that we sell. We're actually a fee-only firm. I sleep well at night knowing that my job is literally to have clients and the best strategy for them, period, end of story. It doesn't matter who makes it or manufactures it. It's just what's the best strategy for them. And so today we've just talked about this bottom right-hand quadrant, which is the investment management piece. And a lot of people start there and they say that this is planning, but typically you're going to cover 4 areas when you're talking about financial planning. You're going to talk about the retirement planning piece. How do I derive an income off of what I've accumulated, which this, in our view, saving and investing while you're working is very different than saving and investing once you're retired and pulling an income from that portfolio. Then you want to take a look at the risk management piece. Then you want to take a look at the estate planning piece as well. And so holistically, this is the approach we take for every single client. If they hire us just for an investment management type of relationship, we're still going to do the planning work, and vice versa. If they just hire us for retirement planning, we're going to do the investment analysis as well. So we can't simply do a one-off approach. I don't feel like we can deliver solid investment advice unless we understand someone's cash flow modeling as well. So we'll stop there for questions, try to be as brief as we could with time. God, looks like. Hey, Brian, here's a question for you. I've had a stock for a long time with significant gains and a low cost. Should I sell?
Yeah, so that's a great question, and that's one that we do run across periodically. We work with a lot of Chevron clients, so oftentimes have a fairly concentrated position in that particular company stock. So a couple of thoughts come to mind initially. So generally speaking, most academic literature when it comes to investments and risk management talks about the fact that no individual stock should probably make up more than 10 to 15% of your overall portfolio, because you start to lose the ability to diversify. And so that's usually a good starting point. Now, in this particular case, where we also have an issue with gains, now we're beginning to look at the overall tax picture. So it's not uncommon where we do have clients who maybe have a concentrated position, and perhaps as they transition to retirement, we're able to essentially engineer a couple of years where they have very little other taxable income. And in that opportunity, we can potentially sell some of that appreciated stock. And a lot of people don't realize this, but if your income tax gets sufficiently low enough, the capital gains tax rate actually falls to 0. And so really understanding, as Chad just alluded to, what a person's cash flow is going to look like helps to inform the strategy. Now, again, depending on the degree of the concentration of the size of the dollar amounts that we're dealing with here, ultimately, we could have a discussion around implementing some sort of put option strategy where we're hedging to the downside. So in that scenario where the stock were to drop, the value of that put option would rise and offset that decline, and now you've hedged yourself. So those are additional levels of risk management that can be brought into the conversation. But yeah, clearly that's an important issue that a client would be contending with. We would want to talk about that for sure.
Last one, for the last 10 years, I've only invested in target date funds. Does that have a similar allocation? I'll take part of that. It depends. I've seen some people the past couple of years that were still in a 2015 target date fund, and it was like, 2020. Target date funds are, you think of them as trying to turn a battleship in a bathtub. It's a predefined allocation based on when you're telling them you're going to retire. So it's not dependent on market cycle. It's not dependent on what interest rates or inflation is doing. It's just an allocation that is age-based. And so, high level, I think they're great because they do get people invested in a allocation that typically would just pick the best performing fund from the past year. So I think they have some advantages, absolutely. You do run the risk, though, as you get closer to retirement of being prone to what the market cycle is doing. So that sort of mean variance optimization type portfolio, you can fall victim to some things depending on what's under the hood, because not every target date fund is the same at all. The recipes are slightly different. And so it has to match sort of what you're doing. I'd say from an income generation standpoint, once you pull the trigger and you're actually in retirement, that'd be tough for me to accept that they're just not income generation vehicles, really. They're going to focus on aggregate bond market exposure at best, and they're not going to really make any quantitative decisions around what interest rates are actually doing in that cycle. And so, it's a challenge from the accumulation stage. Yeah, okay. It's kind of, you're doing the least amount of wrong there, but you just have to pay attention to the underlying allocation.
Yeah, and I got to echo the sentiment there, Chad. The reality is that they can be appropriate for folks, and they're better than doing nothing. God forbid, just parking your money in money market in the 401k plan, for example, using a target date could be certainly a better strategy there. But gosh, we do occasionally run across scenarios where people are, as you alluded to, sitting in like, say, a 2020 portfolio, and we actually sit down and look at their cash flow. We discover that, hey, between pension and Social Security benefits alone, they don't need to take any withdrawals from their portfolio in the near term, and yet they're incredibly conservative in that portfolio that's a target date, and they don't need to be, and they're missing out on potential investment performance that they should have otherwise been participating in. So again, not the worst thing in the world, but it needs to be understood how they work and whether or not they're appropriate for that person's personal financial situation.
Thanks, Brian. All right, that's all the questions we had today. We ran a few minutes over, so I apologize, but if there's any follow-up questions, reach out to us via email or via phone. Happy to talk and answer any questions that you guys may have. Thank you very much for your time today.
Thanks, everyone, for attending, and have a great rest of the day, okay?